Welcome, everyone. Welcome to Keys to the Keys. Once again, another week to learn more about real estate in Chicagoland. This live podcast is dedicated to the people who want to get the top tips and the much needed info about buying homes and selling homes in Chicagoland. I go by the name of Realtor Stephen Taylor. I am your realtor for all of South Chicagoland, from the South Side to the South Burbs to even Northwest Indiana. I am your realtor. Make sure you get in contact with me if you're looking to buy and to sell. So tonight we have the distinct privilege to have a special guest, none other than a good friend of mine and colleague who's going to be speaking to these first time home buyers. Because y'all, I get a lot of questions all the time from first time home buyers. And there's so much to talk about on the lending side, all right, the mortgage lending side, from, what credit do I need and how do I get pre-approved and how fast do I get pre-approved. But the number one question I get is always about the money. How much money do I really need to buy a house? Like, I need the real scoop. Okay, what percentage, what dollar amount do I need? So we have none other than Mr. David Browning, loan officer from Neighborhood Loans, joining us tonight, and he's going to be breaking down a lot of that. Dave, what's going on, brother?
Everything's good, man. How are you?
I'm doing well. I'm doing well. I know you've been moving a lot this evening, but we really appreciate you joining us and coming on to bless us with this information. So, first things first, I know you. We work hand in hand a lot together. But if you don't mind, kind of telling people a little bit about your experience in the business and just who you are. So, who's speaking to us tonight?
I'm a 30-year originator. I've been originating. This will be my 30th year this year in April. And I specialize in first-time home buyer programs, credit counseling, all government loans, down payment assistance programs, conventional financing, all residential. But I've been doing this. I've seen everything. I've seen worst case scenarios. I've seen best case scenarios. So all the in between. So I've kind of been exposed in my career to a little bit of everything. So I kind of know how to work my way around some obstacles that may present issues to prospective borrowers.
Okay, cool. You said 30 years in the game.
30 years.
Wow, you don't look it, brother. You don't look it.
For sure.
So we get a lot of questions. I know, if I get the lending questions, you definitely get them, being, a loan originator in the business. So again, from the credit that we need to the, how long does it take? Like, all these questions, but the number one question is always about the funds. Like, how much money do I really need? Like, that's kind of like the basis question. So how much money do they need, Dave? Like if you're a first time home buyer, like, is there an average? Is there a certain amount that you need to have saved up? Is there a cushion that you need? Like, talk to us about the funds.
None of the above. Those are all misnomers. So down payment and how much money you need vary depending upon several different factors. The first is the type of loan program that you're going to be pursuing. There are three different basic loan programs. It's FHA, which stands for Federal Housing Authority. There's VA, which stands for Veterans Administration. Excuse me. And then there's conventional financing. And those are your three typical loan types. Okay. Now, there are some other caveats to that, like if you own the property as your primary residence versus trying to purchase a property as an investment property, that's going to totally, change your down payment requirements. But for the sake of this conversation, let's uh, let's pursue it as though it's going to be an owner occupied situation.
Right. Yeah.
So on an FHA loan, all right, the minimum down payment on FHA is 3.5%. It doesn't matter if you have a 580 credit score. It doesn't matter if you have a 780 credit score. Everybody's down payment, minimum down payment is 3.5%.
And that's on
So
an
3.
FHA
That's
loan.
FHA.
And you said
That's
those
FHA.
loans are government backed loans.
Those loans are government backed loan, and it's your most prevalent loan type in the Midwest.
Okay.
Okay.
And definitely,
So
definitely for us here in the south suburbs and south side, where we, do a lot of business, like, you're definitely going to see a lot of FHA borrowers.
correct.
Right.
So 3.5% on a $100,000 loan is $3,500. The 3.5% on a $200,000 loan is $7,000. So obviously you have to do the math to calculate, where the price point is going to be and how much down payment you need. Okay. Your next loan type is VA. VA is typically reserved, or not typically, it is reserved for veterans and their spouses only. Okay. So VA loans don't have a down payment requirement. There's zero down to your higher. All right. And you have to be an eligible veteran. So just because somebody was in the service doesn't mean they're automatically eligible for VA. They have to have obtained a certificate of eligibility, and they have to have honorable discharge through a DD-214, which is kind of like a birth certificate from the armed services. Okay.
One more time, Dave.
Excuse me. And then the third loan type.
One more time, Dave, just to make sure they heard you. I think it might have been might have froze on us. So VA is what's the percentage?
Zero down.
Zero down for VA.
Zero down payment for VA. Okay. And then the third loan type is conventional financing. Now, conventional financing varies, the down payment varies based upon the scenario. So if they're a first-time home buyer, how much money they make, their credit score, the higher the credit score, the better the terms. Okay. So, excuse me. I'm choking this evening on this, whatever.
No, take your time.
Pardon me. But conventional financing, the minimum down payment, depending upon where the property is located at and the income, is 3%. So they do have programs that are considered first-time homebuyer programs where you only have to put down 3% as a down payment, which is much better than the FHA at 3.5%. Now, a lot of people might say, well, it's only a 0.5%, but these numbers add up quickly because there are other costs associated, which we'll go into momentarily, that go into acquiring a property. Okay. But the minimum down payment is 3%. There is some misnomers out there that people believe that if you go conventional, you have to put down 20%. That is totally untrue. Nothing can be more false than that. You do not have to put down 20% to go conventional. The standard down payment for conventional financing is 5%. But if you're a first-time home buyer and you qualify, they reduce that down payment to 3%. Okay. So again, 20% down conventional is not true. All right. That is a misnomer. All right. Now, in addition to down payment, you also have what they call closing costs. And closing costs are one-time fees that purchasers pay in order to acquire the property. That's going to be like appraisal, credit report, flood certificate, lender fees, title charges, homeowners insurance.
And this is separate from your down. This is separate from your down payment.
Separate from down payment.
Okay, so we got down payment on one side. So if you're FHA, 3.5% down,
right.
Conventional, usually 5%, maybe 3%.
Right. So you have down payment depending upon the program, which could be anywhere from 0 down VA to 5% down conventional and anything in between, right? But then you have closing costs, and closing costs are those one-time fees that you pay in order to acquire the property. Again, like attorney, home insurance, title policy insurance, lender fees, credit report, appraisal, flood certificate. In some areas, depending upon where it's at, you may have to pay what we call transfer stamps, like in the city of Chicago, if you buy a property in the city. So it's impossible for any lender to tell you your closing costs are going to be exactly $4,800, because no one knows that until we know, number one, where the property is going to be, because you could have to pay transfer stamps to the city of Chicago or some other municipality if they charge you that. But we don't know how much insurance is going to be until we get the invoice. We don't know how much an attorney is going to charge until we get an invoice. And we don't know how much title is going to charge until we get an invoice. And title is the largest of all the fees. So again, you have down payment, which could range anywhere from 0 to 5% down if you go VA through conventional. Okay. But then you have closing costs. And we add these together to call them settlement charges. And that's what's due normally the day of closing. Now, one of the nice things is that through negotiation, the seller can pay all or the majority of the closing costs. It all, again, depends on the program. On an FHA loan and on a VA loan, they can pay up to 6% of the sales price towards closing costs. But on a conventional loan, depending upon how much money they're putting down, it's going to be 3% to 6%. Okay. So the lower the down payment, the less they can contribute towards closing costs on a conventional loan.
So you have these, you got the down payment on one hand, you got the closing costs on another hand. And closing costs, you're saying it's difficult for us to pinpoint exactly what you're going to need because it could change if you're buying in Calumet City versus Chicago versus Flossmoor.
Exactly. Let me give you an example. Let's say you're buying a $200,000 property in South Holland.
Mhm.
Okay. South Holland doesn't charge a transfer stamp, which is a tax basically that the village or the municipality charges in order to acquire the property in that area.
Right.
You take that same exact property, you pick it up and relocate it to Chicago. Now the city of Chicago charges the buyer $7.50 per $1,000. So $7.50 on 200, that's $1,500. So now your closing costs are $1,500 higher in the city than they are in South Holland on the exact same property. So again, it's impossible for any lender to give, what an exact closing cost is going to be. That's why we estimate. Hey, we estimate your closing cost may be $6,000. Hey, we estimate if you buy in the city, your closing cost may be $7,500 because we're going to add that $1,500 that you don't have to pay in South Holland. So it all depends on where the property is located at, which determines a piece of the puzzle of the closing costs. But the other pieces of the puzzle are title insurance, homeowners insurance, attorney. We don't know any of those numbers at the beginning of the transaction because we have to contact those third-party entities and ask them to send us invoices for their services.
Okay. So if I'm a first-time home buyer, again, we're kind of dedicating this episode to them, and I got the 0% VA all the way up to 3.5 FHA, 5 potentially for conventional percent down.
Mhm.
If I'm really trying to save up enough money, and I know what I'll need for a down payment, is there like a range that we can throw out? I know it varies from, city to city, village to village. Is there like a general range that you say, hey, this is a good place to maybe start if you want to save up for your closing costs too?
Again, with FHA being the most prevalent financing in this area, I would recommend that most people start with trying to achieve a 3.5% down payment on the purchase price that they're pursuing.
Okay.
And again, they won't know the purchase price until they find the property that they want, but they're going to have an idea. They're going to have a ballpark. Hey, I'm looking at buying, $300,000 house. Well, then we know,
Because they
3.5%.
looking at Zillow and Trulia, and they kind of know kind of what they have their eyes set on. So yeah.
But you're definitely going to need at least the 3.5%. You see what I'm
Right.
saying? So that's where I would start at. But again, until we find the actual house, we won't know what the closing costs exactly are. But we can always negotiate for closing costs, and that's where you, as the realtor, come into play because we can always go to the seller and say, "Hey, look, seller, I have a buyer that's willing to purchase your property, but they're asking for you to pick up the closing costs associated with the transaction." And that's where this all really boils down to the nitty gritty. And what I mean by that is this. So a lot of people think that, I'm not going to, give a seller exactly what they're asking for a property. I'm going to negotiate it off. What people need to understand is when you negotiate money off of a contracted sales price or an asking price, every $1,000 in today's market where interest rates are today basically changes the mortgage payment $5 per month.
You said what now?
Every $1,000
Hmm.
changes the mortgage payment $5 a month through negotiation. So if you
Wow.
start at 200,000,
Hmm.
that's the asking price, and the client says, "Well, you know what? I want to offer 195." The difference from the mortgage payment at 200,000 and the difference of the mortgage payment at 195 is roughly about $25 per month.
Mm.
And the question is, what can you do with $25 a month right now in today's economy? One time a month, $25. So is it better, in my opinion, to go in and say, "Hey, look, the house is on the market for 200,000. I'll offer you 200,000, but I want you to pay $6,000 in closing costs."
Mm.
Now you're coming to closing with less money, and now
Right.
you're getting the true benefit of what the negotiation process is about.
Because so
So
that
it's better
seller,
to negotiate.
yeah, because that seller, if you go 190, like to them, it's kind of all the same in a sense that it's their bottom line for
They're
them, right?
netting the same amount
Yeah,
of
they're
money.
gonna so
The
they
seller's going to net the same
yeah.
amount of money.
So if it's $5,000 on the price or $5,000 to your closing costs, like it's still for them, the same amount.
Exactly. And see,
Right.
most sellers are not going to reduce their sales price and pay closing costs.
That's tough.
You know, so because in that scenario, you're looking at, well, I want to offer 195 and I want you to pay $6,000 in closing costs. And now the seller's like, wait a minute. Well, after I pay realtor commissions and after I pay title charges, my attorney and all this, I'm walking away with only 170 something $1,000. They're gonna be like, nah, that's not gonna work.
Definitely.
Yeah.
So I know you mentioned that, it's really up to, the realtor to negotiate that and assist with negotiating for those closing costs. Because everybody talks about down payment, but people really don't talk about the closing costs. And I'll tell you a funny story. I talked to a listing agent. She was selling a house in Sauk Village. No, Crete. It was in Crete. Because I had a client who was interested in looking at a house. And so this agent said that they had to put it back on the market because the previous buyer canceled the contract because she found out how much in closing costs she had to bring to the table to bring to closing. And she, I guess, wasn't aware. They didn't kind of give her an estimate or idea. I don't know what happened. That wasn't my client. It wasn't our client, right?
Mhm.
So she canceled it because, like, literally 2 days before closing, and tried to sabotage the deal because she found out she had to pay $9,000-$10,000 in closing costs.
Mhm.
And so, you know, we got to remember the closing costs aspect. That's the other, that's the
Absolutely.
other cost.
Absolutely. And let me share a story with you real quick. This is recently. So I have a client that was buying a piece of property. And so, I broke down all the costs associated with the transaction. And I said, hey, look, we're at the stage where I need you to tell me who you're going to use for your homeowner's insurance. I need to know how much your attorney is going to charge you. Now, these are conversations I don't have with those entities. These are up to the buyer to pursue those and acquire them themselves. So typically we estimate $500 for an attorney fee, but sometimes it could go as high as $750. I've seen $800. It depends on what all the attorney has to do in order to prepare for closing. But then as far as insurance goes, again, we estimate. So we put in to a system, the zip code and the sales price, and it gives us basically what an average insurance is for that area. Okay, it's not saying that that's the insurance that this buyer is going to get, but it's the insurance that is average for the area. So I advise the client, I'm like, hey, go ahead and start shopping around for insurance. Call Allstate, State Farm, American Family. Just call around. And I typically tell people to start with who they have car insurance with because they've already established a relationship with an agent. And normally, those entities, they give them discounts for bundling, having auto and home and life or other policies together. They get discounts. Okay. So in any case, this particular client called around and finally sent me the invoice. And I estimated, because this property was in the city of Chicago, I estimated from the system that I have that the insurance shouldn't be more than $1,800 per year. Okay. That's the average for this area. And so I get the insurance quote, and the insurance quote was like $3,900. And I'm like, wow, this insurance is more than twice as the amount that, I have an estimate for. And of course, this totally changes how much money they have to bring to closing because they have to bring the first year to closing, right? Because they only sell insurance on houses in 12-month increments. So you have to pay the first year in advance, and then we renew it through your mortgage payment called escrow, all right? But the second thing it does is it raises the mortgage payment monthly because now we have to include the renewal of that in the mortgage payment. So she's, going back and forth and saying, hey, I don't understand why the insurance is so high. So I start asking questions. I was like, well, you have any history of claim? And she was like, yeah. I filed a claim last August. And I was like, okay, what was the claim for? And they were like, roof. I had some roof damage and they put a new roof on the house. And I was like, that's it. That's what's going on. There's no way for us to know that when we're doing the initial numbers. We're not having those type of conversations like, hey, do you, what's up with your insurance history? Do you have any history of claims or things like that? It's not until we're knee deep into the transaction that this is normally coming to light. You see what I'm saying? So we had to find her some other insurance because the $3,900 that she was getting quote for, it wasn't going to work. There's no way we were going to be able to get her approved with that kind of insurance. And that's $4,000 that you're adding on top of the down payment and the other closing costs, in order to bring to closing. And that is a similar situation where, if we didn't shop around and get some better insurance or a different insurance, that buyer was going to say, I can't do this. It's going to be too expensive.
Right. Well, I mean, good thing you caught it when you
Absolutely.
did. Definitely. So we got the down payment, we got these closing costs. We can negotiate, which I would say it's pretty common to see buyers,
95%.
especially in our market.
95% of it is.
South side suburbs, Northwest Indiana, like most of the time, sellers are contributing to closing costs. It's something that it's common. Okay, so definitely at least have your 3.5%. So the houses that you're looking at, that you're curious about, that you really like when you're window shopping and scrolling, that amount, take 3.5% of that, and that's a good starting place until we get you connected with David, and he can kind of give you a little bit more insight to it. Dave, what if I don't have a down payment, but I'm really sick of renting, and they're about to sell my building, and they said everybody got to move out, and I'm looking at the numbers, and I realize that what I'm paying in rent, I could actually be paying for a mortgage with that same amount.
Yes.
Okay. But I don't really have a down payment saved up. But I really want to buy a home. Like, what options would you say to that person? Or if a person who's like, I'd prefer to keep my money if I didn't have to use it, like, what options do they have?
There are a couple of different options, but the most prevalent is what we call DPA, or down payment assistance programs. And these are programs where there are grants that give money towards down payment assistance based upon an applicant's profile. And you have to meet the criteria. And some of the criteria can be kind of strict depending upon where the property is located at and things of that nature. But typically what they're looking for in most down payment assistance programs is a minimum credit score of 640 or higher. Okay. You have to accept the terms. These programs carry their own interest rate. They're not always the standard rate that you see advertised for FHA or VA transactions or conventional transactions. These programs are 99% of the time income driven, which means that you can't make more than a certain amount of money depending upon where the property is located at and your family size, so forth and so on. And they take total household income into consideration, which is something that most people don't understand. And what that means is, let's say there's a husband, a wife, and there's a working child in the household. Okay. They're going to use all the incomes, even the income of that child, in order to, because the child is working in his household income, in order to determine the eligibility for the programs. And these programs are for low to moderate income families. So they have lines drawn in the sand about how much a person or a household can have in order to qualify. In addition to that, there can be no felons. In some of these programs, they won't extend financing if the applicant have any felonies in their background, things of that nature. The other string attached to these funds is what we call a recapture clause, and this is probably the most significant string attached to it, in my opinion. So,
wait, you mean like them grants ain't free?
Yeah, nothing is free. Nothing is free. All right. And basically what these recapture clause state is, if you sell, refinance, remember that, we're going to come back to that in a second. If you sell, refinance, change the terms of your mortgage, move out of the property, it's no longer your primary residence, even though you still own it, then within a certain period of time, these programs can ask for that money back. So let me give you an example. So we have a program called Cook County Bond. All right. And this program gives up to $25,000 towards down payment. Okay. So had a client, they used Cook County Bond, got the $25,000, and at the time, rates were at like 7%. Okay. So subsequently, rates fall. I get a phone call within, I want to say, maybe 2 years of the person acquiring the property, and they say, hey, rates fell and I want to refinance. I want to drop my mortgage payment. So I look up the file, and there's a big red flag on the file that says, hey, this is a DPA program. And what that says is that if you refinance, basically you owe that $25,000 back. Okay. Ooh. And on their program, it's the first 9 years for Cook County. So they've only been there 2 years. So now a $3,000 refinance just became a $28,000 refinance. To the save the $150, $200 a month that they're trying to achieve, they would have to pay back that $25,000 that they got as a grant.
Wow. So read the fine
You got to
print.
read the fine print. And we say that all the time. Big print giveth and little print taketh away. All right. Because that
Right.
fine print is what sets all the terms. And those are all the strings attached to the funds.
And I'll say this on a personal note, that's what I do appreciate about working with you, is that a lot of people come over and they first thing they want to know is about, down payment assistance grants and grants and grants and grants. And you really break it down to my clients about the pros and cons, because sometimes it's not the best fit for everybody,
Indeed.
even if they qualify.
Indeed.
Sometimes it is, and ultimately it's up to that client to determine what they want, to do. But I do appreciate that you're not just, pushing people into programs just to kind of, get them approved and keep them going. So
Definitely
you really
educate
do.
and definitely go over that multiple times. But people still, they have to make the decision that's best for them. You see what I'm saying? And
Right.
so I was saying that there's multiple options. There's another option. It's called a gift. Getting a gift from a family member is also an option, meaning that they can give you the amount of money that you need or help you or assist with the amount of money that you need in order to acquire at closing. And there's no strings attached. You can sell whenever you want to. You can refinance whenever the opportunity presents itself and it's feasible. You can sell the property whenever you want to, and you don't have to worry about paying anything back to anyone because they gave it to you as a gift.
Wow. Is there a cap to the gift
No
amount?
cap. No cap.
Wow. Wow. So no cap to the gift
No
amount.
cap.
Wow.
And you
Wow.
normally get
So
better terms, you know what I'm saying? Because now you don't have all the strings attached to the interest rates and things of that nature. So, that's negotiable again.
wow. How many different down payment programs are really floating around out there that people are using now?
Dozens. They don't all have money at this time, but there are dozens. Like Cook County doesn't have money. They run out of money fairly quickly. Like I want to say within 2 months, 3 months, the money's gone because they're giving so much, 25,000. You know what I'm saying? But there's like a city bond, which is only for city of Chicago properties. And some municipalities, sometimes, municipalities have their own programs. Like Chicago Heights has a program every once in a while. But IDA, which is Illinois Housing Development Authority, is the most prevalent. And that's in most areas, not all. Like sometimes IDA might say, you know what, we're not extending these programs in Will County. You see, so it's not only does the buyer have to qualify, but the property itself and location has to qualify as well. It's not just the buyer.
Gotcha. All right. Good info on the grants. If you're buying a house, coming from a lending perspective, do you need to have like a cushion? Do you need to have some reserves there to show the lender that, hey, I got my down payment. Maybe I have my closing costs, maybe I don't. I'm gonna negotiate for the seller to pay that, but do I still need like a little, cushion on the side too?
So reserves, which are monies that are basically still in the account after you close, these are what we call rainy day funds, are not required. Okay, they're not required on all programs. Sometimes, depending upon the property type, if it's a 3 or 4 unit building, they do have reserve requirements on those type of properties. Okay, but again, going back to we're saying it's first time home buyer, it's not required that you have reserves. However, reserves reduce risk, and sometimes putting in reserves in the file will trigger an approval situation where we didn't have an approval previously. So a lot of times when we're looking or discussing a file with an underwriter, we can say, okay, well, look, the buyer has 1 month or 2 months or 3 months of their mortgage payment in a reserve. And a reserve could be in a 401k account. It could be a stock account. It could be a bond account, something that could be liquidated if a person got into a financial hardship and they need to make ends meet. But that's typically, reserves are typically come into play when we're in a gray area. Like, we're just we're not really qualifying for the amount we're trying to pursue. We're trying to push it over a little bit. Reserves help to strengthen the profile of the file. It reduces the
Well,
risk to the lender.
well, that's good.
Mhm.
Good to know. So either way it goes, stack your money, stack your money, stack your money.
Correct. Having your
And I would say
having
this
your own
too.
funds is always, the best because it's just it's less restrictions. When you have to seek down payment assistance or something, you have to accept those terms, and those terms can sometimes be unfavorable to the client, especially if the interest rate is somewhat above normal, or if the client is like, hey, I'm only going to be here 2 or 3 years. I would not recommend, a down payment assistance program if a client is looking at relocating within the first 10 years. I mean, it just
No problem.
it opens up too much opportunity for them to recall those funds back, and you don't want to walk to a closing table and now here comes Ida saying, "Hey, you owe us $7,500 because you just got this property 4 years ago, and we understand you want to get married and you're moving into another house with your fiance, but we want our money back."
Right. Yeah, that actually happened to me. My first home that I bought, I used an IDA grant, and interest rates dropped
Okay.
drastically, down to the threes,
Mhm.
and I still had like a 2 years or so left, on that term with IDA. So I had to like they prorated
Mhm.
it. So my particular grant, they allowed me to prorate it, but
Mhm.
I had to pay some of the money
Right.
back in order to refinance and get that, very low interest rate at the time. So yeah, they for real. You're thinking like, oh, they ain't gonna happen to me. They ain't
They want that money.
nah, they gonna find
Yeah,
you.
indeed.
They gonna find you. Well, Dave, man, I appreciate you coming in. I know we can talk, about so much more about this and other topics, but just to recap, definitely get that down payment, that 3.5%, range there. And if you can get more, for closing costs and
Mhm.
reserves, like you were saying, great. But if not, maybe that can be a good starting point to really get things going and to work with.
One of the things a lot of people ask me is, how long does the money have to be in my account? You know, and so there really is no time frame. You could put the money in your account, between now and closing. You see what I'm saying? But it has to come from an acceptable source. So typically, most people are getting, direct deposit, which is rarely, if ever, questioned because it's self-explained. Hey, this is coming from payroll. At this period of time that we're in right now, a lot of people are getting tax return. Again, it's
Mhm.
rarely needed to be explained unless a person got like a live check. You know what I'm saying? Then we would have to
Mhm.
explain where these funds came from. But typically, we're not going to ask questions about funds that are going into account if it's less than 50% of what a person's gross income is. So
No
hypothetically,
problem.
let's say a person makes $36,000 a year, that'd be $3,000 a month. So as long as we're not seeing any deposits over $1,500, we're not going to ask questions. So a person
Okay.
put in 1,200, not going to ask a question because it maybe they sold something on eBay, or maybe they performed a service for someone one time. These are things that we're normally not going to track down. But if a person puts in $6,000, now it's going to be like, hey, stop the train. Where did these
Mhm.
funds come from? Now we got a paper trail that we have what we call AML, anti money laundering laws that we have to adhere to. So they're going to ask, hey, where did you get these funds from? And they're going to back it up to where you originated the funds from. Did you sell a car? Did you get these funds from a relative? And if so, we need to get documentation from that relative. So it's better to have the conversation with the lender up front if there's funds that you plan on, saving up, and what the game plan is for those funds, because we don't want to
Cool.
cause an issue for anyone.
Gotcha. That's that experience. 30 years of experience, brother.
For sure.
We appreciate it. We appreciate it. Dave, how can people get in contact with you if they have more questions or
Mhm.
want to talk about pre-approvals and start that mortgage process?
Absolutely. My cell phone is on 24/7. You can't try to reach me 24/7 though. I may not even pick up at 1 o'clock in the morning, but my phone number is 773-230-5166. And my email is davidb@neighborhoodloans with an S.com. David B at
One more time.
neighborhoodloans.com.
One more time with that cell.
773-230-5166.
Cool. I'm gonna put up too, for those who want to, connect with me. There's a little QR code that will send you to a site that will allow you to have a one-on-one consultation with me. And that can also be another
Calling
way to
already.
get in contact with David. They calling now? Oh man, let's go. So I'm gonna let you go handle that client then, brother.
Indeed.
But man, we appreciate the time. Thank you so much. Definitely, I can vouch for Dave. He's quality loan originator, a wealth of information. He really breaks it down, gives you the nitty gritty, and will definitely. He gets the job done, and a lot of my clients can speak to that. So we appreciate you joining us. We do this every week, so Dave, we got to get you back. We probably talk about credit and other aspects.
Hey man, I saw something recently, man. You were a top producer at your company? Did I see that? Is that right?
Yeah.
Okay.
I was one of the top agents in units sold last year in 2025.
Nice.
Out of the Oakland office in Home Smart. So yeah, and a lot of that was because you helped me get these people approved.
Good,
so
congratulations, man. Teamwork makes the dream work.
You're right. Definitely. So get in contact with us. You can reach me 708-858-3590, 708-858-3590. Book a consultation with the QR code. Dave gave his information, but I know we'll definitely get Dave back on and talk more. So every week, usually on Wednesday nights, 7:30. Follow, subscribe. If you're on Facebook, Instagram, YouTube, we'll definitely send out reminders. If YouTube, turn on the notifications so you'll know when we go live. And we're giving a lot of top needed tips for buying homes and also selling homes in the Chicago market. So until next time, Dave, God bless. Appreciate you. Anything else you want to say, Dave, before we get out?
Good night and God bless.
All right. Good night, y'all. See y'all next week.